I think we've all heard how great it is to invest in real estate. It seems like every business podcast that I listen to recommends that real estate is a way to diversify your income, create passive income, build wealth, and use good debt to your advantage. But what if you don't have enough money for that down payment? Well, you came to the right place. That's exactly what we're going to talk about today. The thing about real estate is that it's super capital intensive, meaning it takes a lot of money to buy a house. If you're going to buy a $300,000 house, that's $60,000 out of pocket just for the down payment, let alone if you have even some small repairs. They rack up very quickly. $1,000 here, $1,000 there, new water heater, new sink disposal, let alone a new roof. You can very quickly eat away at those returns that you thought you were going to be getting out of this passive income investment. Enter REITs, R-E-I-T, and what that stands for is Real Estate Investment Trust. The beauty of a REIT is that it allows an individual investor to invest in larger real estate projects. So they invest their money into the fund, and then that fund is responsible for investing it into certain types of real estate projects all across the country. Just in case you think that REITs are a new type of asset class akin to crypto or any of the other sorts of crazy things that are popping up on the market seemingly every couple months, REITs have actually been around since 1960, and Congress created REITs, Real Estate Investment Trust, with the very intent to allow the individual investor, people like you and I, to gain access to large real estate projects that otherwise we wouldn't have access to. So by no means are REITs the new kid on the investment block, so to speak. When this law was created, Congress was quite literally thinking about the individual investor, which these days feels a little bit rare. So how do REITs work exactly? I was actually surprised that it's pretty straightforward. A REIT is really just a corporation with a special tax designation. Now, whenever you hear those two words put together, special designation, that usually means something good in the tax world. It means there's been a special benefit set up for this particular situation. And so in the case of REITs, this special designation, it works for both parties. It works for the people who own the fund, and it also works for the investors. It really cuts both ways here. Both parties benefit. This special designation gives REITs a couple distinct advantages. Namely certain tax breaks, but they're also bound by some very specific rules. And for the investor, one of the most important rules is that they're required to give back 90% of their net income as a dividend. And so a lot of these REITs that you will see, almost all of them, and I should say all of them that I'm aware of, return a very hefty dividend, which can be very attractive for certain kinds of investors, especially those who target dividend stocks. With more than 90% of their net income going back to the investor, the dividend returns you will see on some of these stocks are a little bit staggering sometimes. You will see them in the range of 4% or 5% all the way up to 15 or even 20%. And of course, there's a risk-reward sort of situation going on there. As you slide up the scale of the percentage of dividends returned, perhaps that fund is getting slightly more risky or slightly more volatile, but on the whole, the dividend returns on these REIT funds are insane. Another amazing thing about REITs is the accessibility of them. With normal real estate, you would need to go out, you need to find a good deal. Identifying a deal can take 6 months or a year or longer, and then you'd need to fork over the capital, the cash, you need to part with your hard-earned money, and then you need to find a renter. There are just so many steps to getting that piece of property up and running. With a REIT, you simply work with whatever brokerage you already have, so Fidelity, Vanguard, Robinhood, Charles Schwab, it doesn't matter, and you can purchase these REIT funds on the open market. The accessibility is incredible. Later today, you could log into your brokerage and you could purchase one of these. Another thing I love about REITs is that your capital is pretty liquid. If you wanted to sell that fund in a month, in a year, all it would take is logging into your brokerage account and selling, and you could use that capital somewhere else. That's one thing about real estate. You are sacrificing some liquidity there, meaning you don't have immediate access to the capital or the cash that you've put into that property. Now, you might think to yourself, oh, this hot market, I could sell this house immediately. It's no big deal. Well, the real estate market has dipped before, and it will surely dip again. And when that happens, and when there's a lot of inventory on the market, it's not so easy to sell that piece of property that you have. And so this is something that you should take into consideration when you're thinking about your investments. How liquid am I? If I needed that capital, could I easily and quickly sell whatever asset I'm in and just have the cash? In the case of the REIT, you're highly liquid, which is fantastic if that's something that is important to you, if you think that you may need it. One item of note here, when it comes to REITs and these dividends that you are receiving from these funds, They are non-qualified dividends. There are two kinds of dividends out there. There are the qualified and the non-qualified. And you may be thinking to yourself, what does this even mean? Who cares if these dividends are qualified or not? Let me try to explain this to you in some very simple terms. Qualified dividends are taxed at capital gains rates, and non-qualified dividends are taxed at ordinary income rates. Now, if REITs are something that you're interested in, you should definitely do more research on qualified versus non-qualified dividends and the impact that that would have on you based on your personal income situation and tax bracket. But really the point of highlighting non-qualified dividends is that I think you would say that REITs are a little bit tax inefficient. So in an ideal situation, you would be buying these funds in a tax advantaged account. And so you'd be buying these in a Roth or your 401k, somewhere you could strategically avoid paying those taxes that would really eat into your gains over the long term. So what's in it for the owners of these funds? For firms that utilize REITs, they have access to the public market, to investors like you and I, so they don't need to go to individuals to raise capital for their next project. Doing this allows them to work at a scale that they might not previously have been able to, because of the sheer amount of capital that they're able to raise in a super efficient manner. Obviously, with a REIT, they have obligations to the investor, but it definitely works both ways. These companies are making money hand over fist, and the investors are rewarded well. In a way, that's an ideal sort of investment situation. The investor is rewarded for the amount of investment that they put in, and the people who are responsible for returning a certain amount on that investment, they are the ones who are really assuming the risk of ensuring that return. They are also handsomely rewarded. So it benefits both parties. What's really amazing about REITs is that it gives you exposure to a different portion of the market. Whereas previously maybe you were just fully invested in equities, you now are invested in a different portion of the market that is not directly correlated with, say, the S&P 500. And that's really what you want in a healthy portfolio. You want diversification, meaning when the stock market goes crazy, the real estate market is not usually going crazy in the same way. And so that's what I mean when I say it's not correlated, it's not connected, it's not acting in tandem with the S&P 500, for instance. And so just adding a little bit of diversification can really help your long-term returns in your portfolio, and you don't need to go out and buy a rental property and sink all that time into it. You could just invest in a REIT. That's incredibly efficient on so many levels. Another added layer of security with REITs is how their business model works. They tend to have very long commercial leases. We're talking 10 years plus. And what this does is it creates a steady stream of income for the company. And as that income is returned to the company, of course, we know that 90% of their net income is returned to investors in the form of dividends. And so there's this sort of long-term stability that's associated with REITs because of the underlying function of their business model, the way that these leases operate and sort of hold together the entire business. So in an indirect way, you are really receiving money from tenants that are holding spaces in these buildings that this firm operates and runs. I think that's one really amazing thing about REITs. People think that, again, you need to own that single family home and have those renters in there so that you can get that check from them every month. But investing in a REIT is an indirect way, but still a pretty closely related way to have tenants and receive consistent payment in the form of dividends from those tenants. And you're just benefiting from the scale that a REIT operates at. So I think that more people should really consider REITs. Real estate is very complicated to invest in it directly yourself. And so the sort of factors of efficiency that you gain from using a REIT, you allow the experts to do what they do, and you simply get all your time back that you would have dumped into the rental property, and you benefit from their good business practices. With owning a property yourself personally, it really only takes one mistake to seriously eat into your returns. You know, a water heater goes out, or you need to put a new roof on, or you get sued, or you have to evict a tenant. There are just 100 different things that could happen that would seriously damage your returns. There are a couple well-respected REITs, sort of big names that you might hear about if you go and read up on this. And I want to run through them really quickly. I also just want to say that this is not financial advice. This is not something that I necessarily think you should or should not do. I think that you should do your own due diligence. You should do your own research and decide for yourself if this is something that you would want in your portfolio. If you're interested in personal finance at all, you've probably heard of Vanguard. They are an icon of investing. and they have their own REIT fund. It's called VNQ. This fund is probably the most popular REIT fund out there. And like most Vanguard funds, it's extremely tax efficient. It has extremely low fees. And this one, I believe, returns a dividend of about 4% with 8% annualized growth, somewhere in there. This is on the slightly lower end, I think, of what you might expect in terms of a dividend yield from a REIT fund, but it's consistent, it has exposure to the broad market, and it's one of the most popular funds available. Another very interesting REIT fund is VHI. And what's interesting about VHI to me and why it kind of caught my eye is because they only invest in retirement communities and retirement-related real estate. I think this fund is a smart strategic play because we have a lot of older folks in the United States right now, but in the years to come, we're gonna have even more as people continue to retire, and it seems like life expectancies are just continuing to increase slowly over time. This REIT, I think, stands to have some very good performance, especially over the long term. The final REIT fund I want to highlight is a company called Realty Income. On the stock exchange, their ticker symbol is the letter O, and they are just a behemoth in the retail real estate space. They have a very strong dividend, and what I love about this company is that they've been around for, I don't know, 50 years, I think since 1969. So they know what they're doing. Even in the midst of the pandemic, I think they saw 10% growth in revenue during that time. I think that just shows a testament to strong management and a business that knows what they're doing when it comes to managing real estate. And with REITs, that's really what you're doing. You're leveraging someone else's expertise in an area that you may want exposure to, but you don't have the expertise. And I think that it can be smart to just leverage someone else's knowledge for your own benefit. There are so many different options in the REIT space, and if any of this has sounded interesting to you and you want some exposure to the real estate market yourself in your portfolio, I would highly encourage you to just do your own research on funds that are appealing or different sort of market sectors that you've been looking at. But there's no doubt that they offer an awesome opportunity for an investor to diversify their holdings. But as always, there are advantages and disadvantages, so please do your own research. But if you've been thinking about real estate, you should definitely consider REITs. As always, thanks so much for watching. If you aren't subscribed to my newsletter and you are still watching this video, you certainly should. It's calmills.substack.com, and I talk about money, finance, personal growth, and other topics that interest me, and kind of whatever hits my fancy, I suppose. So, as always, just thanks so much for watching. I appreciate every single one of you, and I will see you in the next one.